Please identify yourself. I'd like to know who you are and what you do in 1 or 2 sentences.
My name is Windsor Lean. I'm a student here, and I'm a senior. I'm a political science major. And my question is for Mr. Rosengren. In your first, in your last slide, you talked about how political will in this country is lagging for direct addressing problems, and you evoked Japan. I'm wondering where you see the Fed and their involvement in the political system to sort of create that will and productively, affect decisions that they don't directly have control over. And I guess I'm thinking of how when Chairman Bernanke talks in front of Congress, it turns into the claws come out. It turns into a spectacle. So I'm wondering if there's a better way for the Fed to be involved in the process.
So when I talked about political will, I meant it actually much more broadly to include governments around the world, not just government in the United States. But Chairman Bernanke has talked a bit about fiscal policy, but we are monetary policy, not fiscal policy. Now, when we think about monetary policy, we do have to think about what the federal government's going to do and whether they're going to be tax cuts or government cuts. But we actually have no authority over that. So in the past, the Federal Reserve has tended to focus on only monetary policy. And Chairman Bernanke actually was a strong adherent to that prior to the financial crisis. But we're currently in a situation where fiscal policy actually is critically important. And we're also at the unusual position because of the financial crisis that our interest rates, at least short-term interest rates in the normal way that we operate, are at 0. So that limits some of the things that we can do. Now, we've been fairly creative, and I think we've acted very aggressively. So the Fed's worried about inflation and unemployment, and inflation's not a big problem right now. But unemployment is a big problem. We have 9% unemployment, and we've had very high unemployment for an extended period of time. So we've taken some very unusual actions to try to address that, but actually it would be much more effective if fiscal policy could be a little bit more active. So in the short run, we need a fiscal policy that will stimulate jobs. In the longer run, we have to have a fiscal policy that gets the debt to GDP in control. So that's exactly what Chairman Bernanke has advocated. A lot of economists have advocated this on both sides of the aisle. So I don't think it's actually a partisan issue. The question is how you actually do that. And so it's not so much of an issue of what needs to be done, because I think among macroeconomists there's not that many disagreements, but they get hung up on whether it should be taxes or government spending. They get hung up on other political issues. And that's where the political will comes in, that it's important to get the right compromises to do what's right for the country. Did that address your question?
Yes. If I could just add one little point. I was over at the Federal Reserve Bank yesterday, actually addressing the Greater Boston Real Estate Board in a conference in your auditorium. And I went across the street to see some of the folks at Dewey Square, and there was a big sign which says, "End the Fed." And I wish I could have found the person who put the sign up, because it's about the most mistaken idea that you could find today. The fact is that because there has been this gridlock on the fiscal policy side, if we did not have the more aggressive monetary policy that's been carried out by the Fed, we would really be in very, very deep trouble in this country. We'd be talking about unemployment rates, I would estimate, at 15%, not 9%. And so, thank God we've had a Fed that has taken some of the actions that it's taken, particularly given the fact that instead of having two policies working in tandem, fiscal and monetary policy, we have monetary policy which may in fact have to offset what could be a very sharp contractionary policy that we may see beginning next year and into 2013. Next question. Please identify yourself.
Rich McKean, retiree, and economic ignoramus.
Join the crowd.
Professor Kwoka told us about the good, hard bailout that was so successful for the auto industry, and the soft, disastrous bailout. Certainly many disastrous elements to it for the banking industry, but he didn't tell us why. I mean, even this economic ignoramus can see the insanity that if one of the big problems is too big to fail, and that's worse because today than before the beginning of this nightmare we're still living through with, what is it, 12 to 14 million people for whom jobs don't exist. What does it take to bring about sensible action? Good Lord.
Thank you.
So I think that's a very good question. One answer to it is that the circumstances, of course, are not quite the same. The auto bailout, while it was relatively speedy, there still was a period of weeks and months to figure out exactly what to do. GM and Chrysler were in bankruptcy for 35 to 40 days, which everyone thought was unbelievably quick, and it was by any standard. But there were moments in 2008 where the Secretary of Treasury believed that he had one overnight to decide what to do with some of the financial institutions that were teetering momentarily. So, in fairness, the time frame is a little different, and we may be better prepared as a result of some provisions in Dodd-Frank to deal with banks and financial institutions in financial difficulty in the future. That is, there may not be the same moment-to-moment need to make decisions on a moment's notice. So that's one reason. I think the time frame is simply a little different. I think there are other reasons as well. I think that there is a deference paid to financial institutions that the auto industry has not had in this country politically and in other respects as well for a very long time. I think 50 years ago the auto industry was listened to with great care in the halls of Washington, but their influence certainly did diminish. The influence of financial institutions, by contrast, certainly has not. The Financial Crisis Inquiry Commission reported that in the 10 years, as I recall, 2000 to 2010 or so, that banks and financial institutions both paid in lobbying and also made campaign contributions totaling $4 to $5 billion. So they have an attentive audience.
Frank, you want to add anything?
Yeah, I might just add a couple things to that. One is I think the timing is different. For large financial institutions, you really are talking overnight. There was one institution we didn't bail out. It was Lehman Brothers. Not many people were happy with that outcome. So a lot of our problems are actually that we were convinced that we could actually let a financial institution that actually wasn't large by world standards, was well under $1 trillion, and we allowed it to fail, and there was a lot of collateral damage from that. In fact, the money market fund industry that I went through is one example of that. So we are in a very complicated world, and we're in a very global world. So financial institutions are very global, and money moves around the world. And they're not only just large institutions, some very small institutions, like guarantors of municipal debt, guarantors of various other financial instruments, which were not very large financial institutions, in some respects were too important to fail. So size is one component, but I think there are other elements we have to think about. So with Dodd-Frank, there is the intention to make it much less likely that we have to do this, and that's partly by substantially raising capital requirements, changing some of the things. But I would agree, there are a lot of things that have yet to be done with Dodd-Frank. We're still writing the regulations. We're probably still a year and a half away from actually having all the regulations written. But I think there's some interesting experiments going on in Europe right now. And I was talking to somebody right at the break about Switzerland. So Switzerland has two of the biggest banks in the world, UBS and Credit Suisse. And they are a very small country. So if their banks get in trouble, there is absolutely no way that their taxpayers are going to be able to bail out institutions that are much larger than the size of the economy. So they're being very expansive in what they're thinking about for possible solutions. So what are they thinking about for possible solutions? Well, one of their solutions is a bail-in proposal, which is that there are debt holders. Debt holders automatically become equity holders in the event that the institution gets into trouble. That proposal doesn't involve government taxpayers or anybody else getting involved. It does involve very substantial losses to the debt holders. It would involve wiping out the equity holders. It would involve replacing management. It would not involve the government actually running those organizations. So that's one of the things that the Swiss are talking about. They're also talking about substantially raising capital requirements to make the probability that this happens much, much lower. And to the extent that you make the capital requirements higher, the bigger you get, you provide an incentive for institutions not to grow. So that's not what we currently have. But if the larger you become, the more capital you're required to hold, you start having a disincentive to grow nearly as large. So that's actually in the Basel III proposal. Now you can argue about whether those, which is an international agreement, but it doesn't fully come into place until 2019. So there are a bunch, I don't want to get too detailed, but there are a bunch of regulatory proposals that I think are well worth considering, that are a little bit different than the traditional way of thinking about the bankruptcy code or just straight bailouts by the government. I think there are a lot of things that we can do in between.
Hi, Jen Schwartz, something of a writer. The question is, do you, Mr. Rosengren, President Rosengren, conceive of the Fed as being primarily a profit-making institution along the lines of conventional banks, or do you see other primary functions that supersede profit-making and asset growth, such as the stabilization of the money supply, the stimulation of the economy,
Thank you.
So we're not a profit-making. We do care. So we're statutorily created by Congress. We're a government organization. We're supposed to focus on inflation and unemployment. We're given guidelines by Congress what we're supposed to focus on. And I view myself as a public servant like any other government employee.
Hi, my name is Randy Garden, and I work for the State Executive Office of Elder Affairs. And my question makes a couple of assumptions, and so please correct. I'm going to state them and then correct me if they're wrong. I believe that most of the companies that were bailed out and were bad actors in during the financial crisis were publicly traded companies. Is that correct? Is there some kind of governance? I mean, you talked about regulation, and direct regulation is really important, but it seems to me that the governance of some of these companies was extremely lax, and the shareholders actually did suffer for it. They weren't completely liquidated, but they certainly did take some losses. So do you have any thoughts about what might be changed in corporate governance, especially in the financial area?
Well, I'll let Eric talk about the financial area, where he certainly is more expert than I, but your point, I think, does hold true for non-financial companies as well. Governance arrangements, I think, are really quite weak in many companies and sectors of the economy. There's, like I say, very little explanation why it is that General Motors and Chrysler and Ford, up until the mid part of the last decade, were so badly managed. It was poor leadership, and also leadership that was protected by the boards of directors and could not be dislodged by outsiders. We may all recall that Ross Perot made a run at GM, that Jerome York and the person he works with, whose name slipped my mind, made another run at GM, and they both threw up their hands in exasperation and left. That was a company that was incredibly insular and incredibly invulnerable to outside stockholder pressure. People have calculated, for example, that Ford, over the 15 years ending in 2007 or 8, lost shareholder value of about $170 billion. This is simply taking its market capitalization, adding the amounts of investment that the company made, produced at the end of that timeline, that money evaporated, and shareholders were unable to stop the demise of these, the financial demise of these companies. So I think that, governance issues in this country are really a very serious problem. And I think that certainly on the non-financial side, measures that would strengthen them, which have been attempted in some of the recent legislation, would be enormously valuable in remedying some of the problems that otherwise percolate and grow over a long period of time. I'd be interested in Eric's view on some of the financial institutions as well.
Governance is really an interesting area. And I'm not a corporate finance person who focuses on governance, but it's not just in the United States, it's worldwide. So the Japanese banks basically went under and created big problems in Japan. The Europeans are having a great deal of problems right now, and we obviously had a great deal of problems. So it's not unique to any kind of statutory or kind of arrangements that are focused just on the United States. I think one of the complications is that when you're talking about very large institutions, how much information actually gets up to the board of directors and the kind of expertise that you need. So when I go to a bank board, there are a variety of people that are sitting around as directors, but I would say until fairly recently, very few of them understood derivatives, very few of them understood very complicated financial transactions in a worldwide economy. The risk management that is being used both by regulators and by people in the risk management area are very sophisticated. They require a very good understanding of statistics and economics, and you have to appreciate what can go wrong with the models that people are using. And so the first two organizations that got into trouble were Citigroup and UBS. They got into trouble with mortgage-backed securities that they assumed were not actually that risky. And the assumption that they had made actually was not that different than most people, that their house values weren't going to go down. So the same decision that many people made buying houses in 2005, 2006, and 2007 were the same decisions that many people at Citigroup and UBS were making, and the same decisions that the boards of directors were thinking about, which was housing prices in the United States had never gone down and was unlikely to go down by the kinds of declines that we've actually seen. So I think some of it is governance, but some of it is sometimes things happen that if we hold assumptions that are wrong and don't think about bad outcomes, it really is important to think about those kind of consequences. And thinking about tail events is something we're not very good at thinking about.
I have to identify myself. I'm Chip Case. I taught economics at Wellesley. There's a microphone. Okay. I taught economics at Wellesley for a lot of years. I'm retired now, and I'm following Eric around. Eric and I have been friends. I can't believe this, but it's been 25 or 30 years now. We've known each other, and I was at the Fed as a visiting scholar when the stuff was happening in 90, 91, 92. So this is kind of unfair. I've heard you speak three times in the last 4 weeks.
On different topics.
On different topics, but I'm beginning to think like you. So here's my question. For about 50 years, the housing sector has been a big help to the Fed. That if the Fed wanted to slow things down, it pushed rates up, and housing starts fell. And if it wanted to get out of a recession, it would lower rates, and for 30, 40, really 50 years, starts would go up. And it's a big deal. Starts at peak run 2.5 million. And trough traditionally goes below 1 million for a little bit and then comes back. And so the housing sector at peak is about 6% of GDP, and now it's about 2%. But it's been a real important plus for you guys. Now, all of a sudden, it's not all of a sudden, but over the last couple of decades, we had the dislocations. And starts aren't working anymore. In fact, if you look at housing production, it's gone down by 80%, and it's been down there for 34 months, and it's going nowhere. Now, you're concerned with that sector, and it's sitting at starts about 500,000, where they've been for 31 months, production about 2.25% of GDP, no sign of it moving. House prices have stopped falling, after, by the way, in aggregate, adding $10 trillion to the stock of wealth in the American economy, and then taking back $7 trillion, that's a tough thing to do to the books of any entity. So the question now is the housing market going to help you at all? And it seems like the Fed is quite focused on the housing market. I mean, I read the minutes, and you're playing in the securities markets to keep the mortgage rate down, it seems to me. It seems to me that it's one of the only strings you have left to pull on. But can the economy really come out of this without some boost from housing and some recovery? We've got a lot of problems coming back from Fannie and Freddie on us. They're gonna be trying to get rid of the risk that they're still taking. Fannie, Freddie, and FHA are taking 85% of the risk that's being written in the mortgage market to keep it going. And I'm not sure I can see what's going to keep it going. If we're going to go to risk-based pricing, we're going to see 300 basis points added to the mortgage rate. And there's a credit crunch out there. People can't get credit because the banks are all worried about putting on assets that aren't pristine. So it's a general question. You do without housing.
So I'll be brief.
That's okay.
Dealing with the housing problems is fairly complicated and probably beyond the discussion here. But it is the most interest-sensitive sector, and it is a really critical, important sector for actually trying to get going again. There are some things I think we could do. One, we can affect the cost of credit. I think people are more likely to buy houses if interest rates are low than if interest rates are high. So I think the Fed has some effect, not as much effect as we'd like to have, but it has some effect. But I do think that there are some things that this administration or a future administration could do. One is we could try to get the inventory to move more quickly. And so part of that is that moving from thinking about keeping people in their homes to keeping people in sustainable living situations and trying to clear the inventory, I think, is an important thing to do. And Freddie and Fannie and the various government-sponsored enterprises, I think it is important for them to think about bringing the housing sector back first and worried about some of the risk management issues second. And so I'd be more focused on the recovery right now than some of the things that they're currently doing. So those would be the two things that I think they could do to significantly help the housing sector.
Thank you.
This is really a question for first of all, my name is Larry Moore, and I'm an entrepreneur in the technology field. A long time ago, I majored in physical science. So my question is this: I was struck. This is for really both of you, but it starts off with Dr. Rosengren. In your first slide, you said that one of the really difficult things is anticipating or believing in something that turns out not to be true. And it's been my worry that a lot of the levers that we think are pullable today, if we could only get our hands on them, really don't attach to anything. And so, for example, the belief that if we could somehow increase aggregate demand, that would create jobs. I'd actually like to challenge that. I think that globalization that has taken place in jobs, both menial and non-menial, in the last 15 years, has detached one of these levers from having any effect. And I guess my question is maybe that's true, or maybe you want to debate that, but are there any other things that you're looking at where you're really challenging a fundamental assertion that a given lever is attached to something?
That's a good question.
So I agree with you that lots of things have changed. And the concept that you're talking about is what an economist would talk about as structural unemployment. And rather than give you a long answer, I'll give you a short answer and refer you to a speech I've given to the New England the Board of Higher Education. And in that, I have a couple charts that look at the unemployment rate by educational attainment. And what you see is that If you're somebody who doesn't have a high school education, right now you have close to a 14% unemployment rate. And if you're somebody that has a college education or higher, it's more like 4%. So you're right that there are vast differences. But if you look at the time series and not just the cross-section, so if you look at the pattern over time, the increase in the unemployment rate has actually been more for skilled workers than for less skilled workers, which is the opposite of what you would expect if it was all structural unemployment, and would be consistent with a demand shock that affected all industries and all types of educational attainment the same. So that speech tries to lay out that argument, which is the opposite of the argument that you're making. I'd be glad to talk afterwards if you want to talk more about it, but that speech tries to address that issue, because the implication of it all being structural is there's nothing really that monetary policy can do, and there's not that much that fiscal policy can do.
Right.
And I actually disagree with that view. But we could talk maybe afterwards in more detail.
Ed Scheidler, I'm retired out in Needham. I understand our economy is driven 70% by consumption. And in the recent history, our consumption was driven by our industrial and manufacturing jobs, where people were employed at a level of income that allowed them to have discretionary spending, which then churned and fueled our economy. With our current situation of underemployment and unemployment, do you think that a major portion of our society is going to be looking forward to a reduced standard of living?
So I think we have some very significant short-term challenges that we have to address. But I firmly believe that the public policy is done correctly. There's nothing fundamentally different about the productivity of the U.S. workforce or U.S. capital. We have to get the policies right, and bad policies can result in really bad outcomes. But if we get good policies, I think we get really good outcomes. And we are becoming a more educated workforce over time. New England's a perfect example of that. Our unemployment rate is much lower than the rest of the country. We have a much higher educated workforce than the rest of the country. So I think that there's still plenty of opportunities, and there can be plenty of opportunities, but there are mistakes that can occur in our own policies, and there are mistakes that can be made in China and Europe, and I think that's one of the fundamental differences, is now mistakes made anywhere in the world can have implications for us. And that's one of the consequences of globalization. There are good things about globalization, but there are also bad things about globalization. So Greece is about the size of Ohio, and normally you wouldn't think about problems in Ohio possibly taking down the world economy. We're in a world where all of a sudden a country that's relatively small is having a big impact on financial markets around the world and growth and world growth. So we have to think about the consequences of that. We really care if the Europeans get things wrong, because it will have an impact on us. But fundamentally, I think in the longer run, there's no reason why the U.S. economy and our children can't have a higher standard of living than we do.
Let me, if I may, weigh in here just a bit by saying that in looking at changes over a long period of time at the changing industrial structure in the U.S., I think there are causes for concern that probably all of us are aware. The deindustrialization of the U.S. economy is not entirely benign. It is true that education and service jobs and other sectors take up some of the difference, but it is also widely, I think, understood that the ladder that has provided mobility to an awful lot of people from one stage in the economic and social chain in this country to the next stage, that the middle rungs of those, the manufacturing jobs that provided good stable incomes and platforms to educate their children, very much my own heritage and tradition, that those rungs are noticeably weakened. And so a bifurcated set of job and employment opportunities in this country is a matter of some concern. And that, it's hard to discuss that without raising the question of the trade imbalance, particularly with a country or two that is not playing by the rules that everybody else plays by. And so the trade imbalance with China, it seems to me, is a proximate cause of a great deal of harm in this country and in others as well, mind you, and represents something of a continuing threat to the social and economic fabric here.
Carlton, I have a question for Dr.
Who are you?
Sarah Garland, I work for the State's Department of Education. And I'm Rosengren. And it's about what seems to me to be one of the kind of mysterious cogs in the big machine, which is the ratings agencies. My understanding is they're private, perhaps even profit making. My understanding is they have, I mean, there's been a great deal of news just today about their stance toward rating Greece's debt, and all the times when there were these huge signals that there was an enormous problem that they decided not to pay attention to. There's certainly been plenty of stories in the news over the last several years about the mortgage-backed securities and so on. And I really wonder, is that one of the places where the system really failed? And is what, if anything, has happened about that, the nature of that institution, the private ratings agencies?
So I agree with you that private rating agencies were a big part of some of the issues that we faced. So I gave an example of two banks that had bought mortgage-backed securities. They were the AAA rated mortgage-backed securities. And they had been heavily dependent on the rating agencies for their assertion that they thought they were relatively low risk. So financial institutions, like many, depended on those ratings. They are a private organization. It isn't an issue that was really addressed with Dodd-Frank. Dodd-Frank did require regulations to be rewritten so they weren't as dependent on rating agencies. But the problem is it's endemic to an awful lot of what we do. So I gave the example of money market funds. What they hold is dependent on what the rating agencies have. If you look at the pensions that professors at Northeastern have their money in, my guess is there are restrictions on the credit quality, and it's tied to the rating agencies. Municipalities and state government frequently have limitations on what they can hold in terms of the rating agencies. So it's not just the government, it's basically we have a whole infrastructure that's tied to the rating agencies. Again, it's a topic for a longer discussion, but the incentives are not appropriate for the rating agencies right now, and I think it's probably an area that over time we need to give a lot more thought to. The Europeans are giving a lot of thought to it as well. Particularly with the downgrades that have occurred both at their banks and for their sovereign debt. But I think that it's an important issue and it's not an issue that's been fully addressed.
Eric mentioned the magic word to economists. The reason, of course, he did is that he knows this full well, and that is incentives. Much of what has run through the financial debacle of the last 5 years and in the 10 years leading up to it have been compromises of incentives of agents that we believed were playing particular roles. And the ratings agencies are a very good example of that. But proprietary trading, the breakdown by Glass-Steagall of the historic separation, and many other examples illustrate the fact that the inability to preserve intact incentives for entities to play the role that all of us maybe historically believe they were, does lie at the root of a great deal of what has occurred. One of the questions this raises is how to restore those incentives. There really are, broadly speaking, two rules, and this actually comes out of a fair amount of antitrust policy. You can have behavioral remedies or rules, thou shalt not do something, thou shalt do something, and have monitoring and enforcement techniques that try to ensure that the entities adhere to those rules. A cleaner and easier technique, of course, is to have a structural separation. It means that the incentives are clear and that there is less need for public oversight of the entities that have been separated. Coming out of an antitrust tradition, as I do, structural separation and regulatory as well, structural separation has enormous advantages in many cases. And it seems to me that the burden should lie on those who believe that remedies that rely on rules and behavioral proscriptions somehow are sufficiently effective or are necessary because there are substantial economies or other benefits from allowing integration of different functions. But it seems to me we have been beset by the failure of clear incentives and the reliance on weak rules and enforcement.
We have time for one more question.
school bus. So there is hope for the future. Anyways, my
Glad to
question-
see that our students are getting employed.
Right. My question has to do with, I just look at the system now. To me, it seems like nothing is really changing all that much. I mean, you still have a revolving door of people in Wall Street running up in Washington as advisors to Obama. There seems to be not enough regulations being put in place to try and control, regulate derivatives, which I think was part of the problem to begin with when Al Greenspan at the Federal Reserve did not want to regulate derivatives, which, again, I think he's helping out his buddies in Wall Street, which, as you mentioned, public policy is, if it's good public policy, then we all benefit. If it doesn't, it can be a disaster, as we saw. Now, one thing I'm looking at is today the stock market went up about 500 points. And I was just, again, the market just goes up and down. It's just these crazy gyrations. And I was been reading about a speculation tax. I'd like to know what you think about putting a tax on any kind of transaction that's done in Wall Street, whether it be the selling of a stock or a bond or a derivative that would try and help so the market wouldn't have these great gyrations. And we get a little more money that of course, the government needs now to pay down its debt. So I'd like to know what you two think about trying to control Wall Street, at least the market a little better, and also provide some revenue for our deficit.
So that actually is, the Tobin tax is issued by James Tobin from Yale, who actually suggested that putting a tax on transactions might have beneficial effects in moderating speculative behavior. There are a couple complications. One, in a global economy, you're going to trade financial instruments wherever there's not the tax. So as long as it's a financial instrument that can be traded anywhere in the world, if we had that and Europe had that, but the Cayman Islands didn't, Cayman Islands would all of a sudden have a wonderful financial sector. So you really have to do it on a global basis, not on a national basis, so that's a challenge. I think it would be a very effective revenue raiser, but the amount of tax that people are talking about tends to be fairly modest amounts. And so if you're talking about a very small per transaction tax, I'm not sure it'll have a big effect on speculative behavior, where when you talk to a hedge fund, they're hoping to get a 25% return on investment per year. So you're not talking about a transactions tax that's going to be particularly high. So I doubt the hedge fund behavior would be dramatically changed even if you could do it on a global basis. But I do think from a revenue raiser, it might be a fairly efficient way to raise revenue. So if I were to do it, it would be for the revenue raising capabilities rather than for it curbing speculative behavior, which I'm not so sure it would.
The question began by talking a bit about personnel changes, revolving doors, and the like. So I'll leave Eric's answer as the one to be listened to with regard to this speculation tax, but I would like to comment on the issue of personnel again. I mean, my feeling, as of course you saw clearly from my presentation, is that much of the moral hazard, a word we have yet to get to, much of the moral hazard associated with intervention in financial institutions, with bailing out the banks and financial institutions, much of that can be remedied, at least a significant part of it can be remedied, by ensuring that there's a change in personnel. It seems to me that this has political benefits for sure. Many people are irate at the continued presence of individuals at the head of financial institutions or the golden parachutes with which they exited. It seems to me it's enormously beneficial to have a sense that house has been clean. And it seems to me that that is a fundamental economic and business and political misjudgment not to ensure that that has been done. That's only one small piece of it, but it seems to me that the concern that everyone has over moral hazard does have, at least in part, that solution. The other thing I want to say about personnel is that it's been a pleasure for me to be sitting here next to a president of the Fed who I certainly and many people have long admired. We've been privy, I think, to his candid thoughts about what needs to be done, and I think it's been very refreshing to hear that, and I want to thank him for that.